If you are a first-time home buyer in California, you might want to check out a new program that CalHFA has come out. It's called the Dream for All Program Shared Appreciation. This program can allow you to actually do almost 100% financing on your purchase. That might be a good thing, maybe a bad thing. We've gotten some preliminary information on how this program works. So I wanted to bring in our loan partner, Ken McKee, to explain how this new Dream for All program is working.
Sounds good. Yeah. So this program was announced, it's been in the works for a while, but it was announced. We just got the flyer on the 3rd of March, and it's set to be released or available to the public on March the 27th. So what we know now is that it is a shared appreciation program. So it allows a buyer to have a first loan that's a conventional 30-year fixed loan, and then a second loan that's up to 20%, and that's a silent second. So there's no payment on it, and there's no interest that accrues over time. And that can be used for the down payment. It can also be used up to 5% of it can be used for closing costs. So if someone has a little money to bring, they can use it for that. If they don't have enough money to cover all the closing costs, they can use some of the loan to cover it. It is available for first-time home buyers. And when you sell the house that you're in to pay off the loan, or if you refinance to pay off the loan, you end up owing back the original 20% that you got, the silent second, plus some of the appreciation. So if you make, like, roughly in the Sacramento, Placer County area, if you make roughly less than $82,000, you only pay back 15%. If you make up to $202,000, which is the program limit, you're going to owe back 20% of the appreciation. So if the home, let's say, goes up $20,000 from the time that you bought it till the time you're ready to sell it or refinance it, then you would owe 20% of the $20,000, which would be $4,000 plus the original $100,000.
So to be considered a first-time home buyer, you can't have owned a home within the last 3 years, correct?
Exactly.
And this program has a minimum credit score of 680. So that 20% silent second that you're not making payments on, you don't have to pay interest every month, which is a benefit, but you can also not pay mortgage insurance. So the savings on that could be hundreds of dollars a month just by having that part of the program.
Yep. Depending on credit score, somebody with a 680 credit score, that mortgage insurance is higher than someone with a 780. So yes, but you're right. You're going to save hundreds,
Mm-hmm. But I think there's a lot of misconception on social media right now. I see some people that are splashing this on social media. I mean, they'll say you get 20% free towards a house, and that's not what this is. Yeah. You have to pay that 20% down. So if you bought a house, you make under $202,000 in the greater Sacramento area, then you are going to, on a $500,000 property, you're going to have to pay that $100,000 back plus the appreciation. Some of the downfalls that I can see happening with this is that what happens if someone wants to refinance when rates are lower? And you don't really have much information on that portion of it yet. Yeah,
we don't. There may be a clause to allow provision to allow a one-time refinance, as long as the buyer is lowering their rate at least by 1%. And then the silent second would subordinate behind the first. So it would stay in the second position. You would just be able to refinance the first into a lower mortgage. You would have to pay closing costs for that. That's, a few $1,000s probably. You probably will need an appraisal because it's a conventional loan, all that stuff. And so you'll have to fit that, and I'm sure that will all be done through CalHFA. I don't know. It could be done through a regular conventional mortgage, or it could be a CalHFA conventional. We don't know yet. And we don't even know if you'll even be able to do it. So that brings up a good point. Like, if you think about it, like, if you didn't have the money for a down payment up front, then how are you going to get with the money to repay that, in this case, $100,000 in what, 1 year, 2 year, 3 year, 4 years? I don't know. And we don't know what the rate's going to be on this program. But if it follows CalHFA's kind of current practice, it tends to be sometimes about 1% higher, somewhere in that range, 1% higher than what you would normally get just with a regular conventional loan. So, you could, one of the downsides of it, you might stay in this for a while and not be able to get out of it.
Yeah, and some alternatives for that, if you can qualify income wise for, the payment on the 500,000, you could put 3.5% down, do an FHA loan, and then, in a couple of years, if rates go down, which we all hope that they will, you can do a streamlined FHA loan. There's no appraisal, and you would just have to pay the closing costs on that, and it's less tricky with not having a silent second.
Right. And if that 1% lower rate, or if you're able to get out of the loan and if you're able to refinance sooner, is my point, and you're maybe doing that FHA with a streamlined refi. By the way, FHA just lowered their monthly mortgage insurance by 0.3%. So big help. And it brings it closer in line with a lot of conventional loans. So you may stand to save a lot more money by refinancing in, say, a year if rates drop 1%, 2%, whatever they may drop, than having to stay in this loan until you can come up with the money to repay CalHFA for that 20% down plus the appreciation.
Yeah. And also you have conventional options too with low down payments as well.
Yeah. 3% is really attractive now. Fannie and Freddie, which are the two entities that underwrite conventional loans, just dropped their mortgage. They dropped their mortgage insurance. They dropped some loan level pricing adjustments of fees on 3% down loans. And they're much more attractive. They're much more like 5% down or 10% down.
Mm-hmm.
So, yeah, definitely.
Well, if this was all completely Greek to you, you are not alone in trying to figure these, blurbs that come on the news about programs. But that's why we have loan professionals that help us guide us through this process. This program is being rolled out on March 27th. So if you are in a first-time homebuyer bracket, you haven't owned in the last 3 years, you're looking to become a homeowner, I would reach out to Ken's team and you can get yourself pre-approved, and then they can look at all the options and show you what's maybe long-term based on your needs, the best program for you. Because sometimes I'll have clients that will call me and say, oh, I heard about this first time homebuyer program. But when we look into all the nitty gritty details on the program, they oftentimes will have more downsides than plus sizes to them. It sounds great. And I know a lot of agents are saying free money, but it's really not free money. And so I wanted to come and get this cleared up so people don't get distracted by that. There's also limited funds, right, Ken? I think they said like for the whole state of California, is it like how much, 50 million?
It's not a lot. I mean, it sounds like a lot, but when you start looking at it in $100,000 to $150,000 chunks, it's not that much.
Yeah. So the funding will be replenished based off of people refinancing out of it or selling the property. Right. So, the program could be around for a long time, but probably a lot of effort is being put behind this that will benefit very few people and maybe not really a benefit for most, just with the terms with the program. Right.
Yep. And I think that, there are other programs out there that this could be a program that helps a ton of people. And I'm sure it will. There's also some other programs that CalHFA already has that are really good. And like you mentioned, there's also just regular old conventional loans. I mean, it's we live in California, and there is a chance sometimes that people can get a gift they didn't think they could get a gift. So you never know.
Yeah. And I think I just read some statistics on that. Since the pandemic, 41% of buyers that are first-time home buyers got some sort of gift in the process of their home buying experience. And I get a lot of clients that, are renting, they're working really hard. They've got a lot of expenses just living in California. And they're like, oh my gosh, I don't know how people do it. And the sneaky side about it is a lot of them are doing it with help. And there is some people, I think I read recently around 7% of people are getting co-signers that are first-time home buyers too. Yeah. I don't know if that's true, but that's one way. I think parents long-term will think, hey, this is an easier way for me to help out a child to get them to stay in the state than move outside of California, right?
Exactly.
So, well, all right. Well, thank you for your time, and reach out to the Ken McKee team to get pre-approved and to get more information on this program, and take care.
Right on. See ya.
Okay.